Hi, I'm Jimmy. In this video, we're going to look at one of ARK Invest's largest ETFs, known as the ARK Innovation ETF, ticker symbol ARKK. Our goal with this video is to get to better understand what the ARK Innovation ETF does and to see if we can identify some of the strengths and weaknesses of this ETF. Okay, so let's jump right in. So the ARK Innovation ETF sets out to invest in companies that they call disruptive innovation companies. Things like robotics, artificial intelligence, DNA sequencing, blockchain, the list goes on and on. Now, typically, this ETF invests in somewhere between 35 and 55 companies at a time within the ETF. They got launched. The ETF itself was launched in October of 2014, and it's managed by Cathie Wood and her team. Now, just so we're all on the same page, ETF is short for Exchange Traded Fund. So basically, if we bought this ETF, well, this would mean that we bought a pre-built portfolio of stocks. And in this case, those stocks are fast growth companies that are trying to change the world. So if we're not sure what company we should invest in, well, it might make sense to invest in the entire group of companies that in theory are doing this. This is the group of companies that ARK Invest has handpicked that belong in this portfolio. Now, this ETF is actually an actively managed ETF, which is a bit unique. Most ETFs track an index, and that index is built by a set of rules. With the ARK Innovation ETF, well, Cathie Wood and her team actually select the companies that go into it and how much of each company belong into the portfolio. Now, with that being said, these are the holdings that are in the ARK Innovation ETF based on how their portfolio weight, which is basically how much of the portfolio each stock represents. The more the company represents, the higher their weight, well, the more important that company's performance to the ETF really is. We can see that Tesla here represents about 11% of the ARK Innovation ETF. Now, I should point out that these weights can actually change fairly quickly. Now, let's imagine that none of the stocks, they all stayed about the same one day, and in this case, Tesla, which represents about 11% of the portfolio, skyrocketed up in price. Well, if that went up in price, the weight, the importance to this ETF would increase. Same is true vice versa. If Tesla collapsed, well, the weight would decrease. So with that being said, well, we can see the types of companies that the ARK Innovation ETF ultimately invests in. They're fast-growing companies that have performed, frankly, fairly well in recent years. So much of the past year has been great for this ETF. In fact, this is what the chart looks like for the ARK Innovation ETF. And clearly, this was a very impressive run. Over this past year, the ARK Innovation ETF is up about 160%. And yes, granted, that is coming off of pretty close to the bottom of last year. Last year, the stock market pulled back. So 1 year from today, coincidentally, is coming off of about the bottom of last year. But still, this 160%, if we were to compare that to something like the S&P 500, well, the S&P 500 was up about 50%. So this ETF is up more than triple what the S&P 500 is, which again is fairly impressive. And I should also point out that during this time period, well, the ARK Innovation ETF has actually paid a dividend in December. They've done that for the past few years. They pay a dividend in December. So this most recent December, they paid about $2 or so in dividends. So that actually adds to the total return of the portfolio. So the actual return over the past year would be like 163%. Now, just to really understand what is driving this very impressive performance, there's something that we can look at known as the contribution to return, or basically what is the impact that each holding has had on the performance, on the total performance of that particular fund. Now, just to show you what I mean real quick, let's look at a single stock like Zoom. Well, we can see that Zoom represents a bit over 3% of the total portfolio. And if the ARK ETF had owned Zoom for the entire year, well, Zoom during this time period, coincidentally, was also up about 160%. So we would simply take that 160% and multiply it by the weight. So in this case, about 3%. And with that rather simple math tells us that this one holding would add about 5% of total return to the portfolio. But in this case, well, ARK actually, they added a bunch of Zoom very recently. It was just a month or two ago. And during that time, well, Zoom is actually down a bit. And this means that owning Zoom has actually dragged down their performance by about 1.1% since they've held it. And I actually use this one as an example because there were very few stocks that they had that hurt their performance. Most of their stocks did well. And this is the impact that each of their holdings over the past year have had on the total return of the ETF. And if we snap back to the top of this real quick, well, we can see that their top 5 performing stocks by contribution, how much they added to the total return, well, they actually made up the majority of the returns for the ARK Innovation ETF over the past year. Together, these top 5 stocks have added about 96% to the total return of the entire fund. So nearly 2/3 of the fund's performance are because they owned these particular stocks. Now, I'm not saying this as a criticism. Believe it or not, this is usually how investing goes. I'm sure many of us have seen this with our own personal portfolios. We might buy, let's say, 20 or 30 different stocks, maybe even 50 stocks, and out of that, maybe just a small handful, maybe 2, maybe 5, maybe 6 or 7 are driving the performance either up or down. And that can have a big impact, but that is usually the way it goes. The reason this is one of the benefits of diversification. You diversify as much as you can because who's to say that these top 5 stocks right now don't have a great run over the next year, but maybe the next 5 have a really phenomenal run. Now, of course, the flip side to this is that if some of the larger stocks, now some of the stocks with a bigger position, more weight, well, if those stocks underperform the stock market or go negative or have a bad year, well, it's very possible that those highly weighted stocks drag down the performance and ultimately the ETF might not do as well over the next year or so. So perhaps we think that hyperinflation might come, maybe even not hyperinflation. Maybe if we think inflation in general is going to go really high, well, a lot of these stocks would not do well in that scenario. And if that's the case, if that's what we believe, then we might want to stay away from this ETF. If we think that these stocks or these types of stocks are going to be instrumental, so they'll continue to move higher, well, maybe it makes sense to get involved with the portfolio. And this actually brings us to some key features of the ARK Innovation ETF. So this ETF has an expense ratio of about 75 basis points. So that's 0.75% on an annual basis. And they have almost $18 billion in assets. So looking at just these 2 facts alone, well, the assets under management, well, that's how much money they have in the fund, how much they have to invest. And that's actually a decent amount of assets to have. And that could ultimately affect their performance. So here's what I mean by that. Let's pretend that there's a small company market cap, a couple $100 million, that could be a very good position for them to have. Well, in order for that position to have a decent amount of weight in the portfolio, and ultimately if that stock went really high to really have an impact on the fund, well, they would have to take a very large position for it to be a meaningful piece of their portfolio because they have so much assets under management. A lot of times, more assets can be it can be a drag on performance. Now, luckily, there are plenty of large companies out there that are innovating enough that it might qualify for Cathie Wood to add them to this portfolio in general. So I think that they'll probably stay away from some of the super small companies, but stick with the larger ones. Luckily, there's plenty of them. Now, the fee of 75 basis points is a bit on the higher side. But as I've said in the past in some other videos I've done on ETF fees, I think that it is okay to pay higher fees if that particular fund, or ETF in this case, is serving a very specific purpose. And I think this fund qualifies as that. And given how well the ARK Innovation ETF has performed, especially over the past year, well, I'm sure that many of us are willing to pay what turns out to be a modest fee relative to the total performance. But that performance may not hold up. So I think that right now I'm okay with the fee. Actually, I'm fine with the fee in general. I think that, again, this is an acceptable fee for a very specialty type of fund. And I think that this one does it. So I have no problem with that higher fee. Plus, I haven't found too many funds, too many ETFs that do exactly what Cathie Wood is trying to do. And if that's the case, if this is the one access point, well, fine, a higher fee, that's okay. Now, if you happen to know of any funds or any ETFs that directly compete with the types of companies they invest in, please let me know in the comments below. Okay, now this brings us to the question, does it make sense to invest in this ETF at this point? And here's my issue with it. Given how far up it has been, given the hurdles that the ETF will, it is very unlikely that they repeat the performance from last year for any extended period of time. But I do think it makes sense. I think it offers solid exposure to these types of companies. I think having an ETF like this as a piece of our portfolio to complement, to give us access to some growth stocks. Growth stocks can be tricky to pick out. So if we didn't want to pick out individual growth stocks, we wanted this portfolio to represent the growth component of our portfolio, I think that makes tons of sense. And I think that it could be a smart move. But I think it really makes more sense if that is a very long-term holding and we can deal with the inevitable volatility that this portfolio will bring. Now, for me, on a personal basis, well, I prefer picking more value stocks than growth stocks. If I was looking again for the access to these types of companies, this might be a good way of doing it. But because I prefer picking individual companies, the way I'll use this ETF is what I'll probably be doing is watching this ETF to see what stocks they add or which ones they sell off. And perhaps if we can find one that they add, maybe that's a good company to research quickly and see if it makes sense to invest in it. So for me, I'll be avoiding this ETF. In the meantime, if there was ever a pullback in these types of companies and this ETF looked like more of a value play, I'm in. But in the meantime, I think it makes more sense for me to stay out of it. And again, that's probably because I, again, prefer value stocks or dividend stocks. And although I'm building my portfolio now and I'm not reinvesting the dividends that I receive into these same stocks, I'm actually reinvesting those in other, hopefully, value stocks that I can find. And I think that that's a more logical way for me to personally build my portfolio. Now, if you're curious why I'm not using dividend reinvestment plans to reinvest back into the same stock, well, I actually did a video where I go through some of the pros and cons of dividend reinvestment plans. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.